The silver market just flipped into a regime where the paper price can ignore physical stress, and that asks exactly why the next leg could look impossible to anyone watching only headlines. Because while the crowd argues about personalities and politics, the real pressure is building in places most people never look: spreads, deliverable inventory, and the quiet mechanics that force traders to buy when they least want to. And if you stay with me, I'm going to show you the one hidden detail that reframes the entire move: the calendar trigger that makes later suddenly become right now, and the specific levels and signals that matter over the next 1 to 2 weeks, so you can tell the difference between a shakeout and a structural squeeze. Here's the part that makes people emotional. Silver has been moving fast, not up a little fast. I mean the kind of velocity where the tape starts to feel like it's breathing. Wide candles, thin liquidity, and those sudden air pockets where a market jumps like it heard a loud noise. That speed matters more than any round number target, because speed is what breaks risk models, triggers margin calls, and forces dealers to hedge into the move. It's also what turns a normal rally into something that feels like it's ignoring gravity. And that's where the mainstream commentary usually goes off a cliff, because they'll debate whether the move is justified when the real question is whether the plumbing can handle it. Now, about the Trump silver move framing, most people hear that and assume it's a soundbite, a rally speech, a meme, a personality-driven trade. That's not the cleanest way to think about it. The more useful angle is incentives, policy pathways, tariff risk, and the way markets front-run uncertainty before a final decision even lands. In metals, the fear of friction is often more powerful than friction itself, because supply chains don't get to wait and see. Procurement teams don't get to shrug. Refiners don't get to teleport. When tariffs or trade rules feel like they could change, buyers pull forward demand, reroute flows, lock contracts, and hoard optionality. And that, right there, is how a policy narrative turns into a physical market problem. But that's not the hidden detail yet. The hidden detail, the thing that flips this from headline trade, promising gut to structural setup, is that the stress can show up before the policy event happens in full. Now let me say that again, because it's the key. The market can get tight from the positioning around a threat, not just from the final rule. That means even if the loudest headline later says exemptions or delays or not as bad as feared, the metal may already have moved, already have shifted custody, already have been pulled into a different pocket of the system. And once metal changes hands and location, it doesn't automatically flow back like water. It becomes sticky. It becomes strategic. It becomes insurance. And that's where the real pressure starts. To understand why this matters, you have to stop thinking of silver as one big pile of shiny metal. Silver exists in different forms in different locations, and not all of it is available to solve a shortage on command. There's silver that exists in vaults, silver tied up in financing deals, silver earmarked for industrial use, silver sitting in forms that are expensive or slow to convert, and silver that is technically there but practically unavailable. The market cares most about the slice that can actually be delivered against obligations and used to settle trades without drama. That's why you'll hear serious people talk about deliverable supply. It's not a conspiracy word. It's a logistics word. It's a risk word. It's a can you actually get it in the right form on the right timeline word. And that's where paper versus physical becomes more than a slogan. Futures markets are incredible at one thing, creating continuous price discovery. But they're also very good at hiding stress until the stress hits the delivery window, the roll, the spread, or the financing chain. You can have a futures price that looks calm while the physical market starts to whisper, then talk, then shout. Premiums rise. Availability gets patchy. Lead times stretch. People start asking for alternatives. Dealers start quoting subject to confirmation. And those are not vibes. Those are symptoms. The next detail is what flips the whole setup. The cleanest lie detector in commodities isn't a headline. It's the term structure. That's the relationship between near-term contracts and later contracts. When the market is comfortable, when there's plenty of supply, later delivery is usually a bit more expensive because of storage, financing, and time. That's a normal shape. But when the market wants metal now, it starts doing something different. Near-term contracts can trade richer than later ones. In plain English, the market pays up for immediacy. That's a huge tell because it's not a retail investor thing. It's not a tweet thing. It's the system admitting that the next few weeks matter more than the next few months. And here's why that can get violent. If the front of the curve gets too tight, it forces behavior. Shorts, who normally roll their positions forward, have to pay a larger cost to do so. Arbitrageurs, who normally keep the curve in line, start to demand more compensation. Anyone who needs to be short as part of a hedge has to decide whether that hedge is worth the pain. Liquidity providers widen spreads, and suddenly what looked like a price chart story becomes a risk management story. Because if this one level breaks, the math changes. Now let's talk inventory, because this is where people get misled. You'll see some numbers float around, vault totals, reported stocks, this chart, that table, and people will either panic or dismiss the whole thing based on one snapshot. That's a trap. The better way to think about inventory is categories and mobility. Some metal is in the system, but not readily available to deliver. Some is eligible, but not registered for delivery. Some is sitting under a claim. Some is there, but pulling it out triggers costs or taxes or time delays that make it effectively locked, at least in the short run. So when someone says inventories are high, your next thought should be high for whom, deliverable to whom, and how fast can it move? And that brings us to one of the more underrated dynamics, custody and stickiness. When uncertainty rises, policy uncertainty, tariff uncertainty, geopolitical uncertainty, metal gets treated less like inventory and more like collateral. It becomes a balance sheet asset. It becomes something you don't casually release. That doesn't mean people are evil. It means people are prudent. And prudence in a tight market looks like hoarding. You can see this in real-world symptoms. The first symptom is spreads behaving strangely. The second is reported availability getting inconsistent depending on where you ask. The third is premiums and delays in retail channels, sometimes noisy but still informative when they line up with the other signals. The fourth is how quickly the market responds to small bits of demand. A healthy, well-supplied market shrugs off demand spikes. A stressed market flinches, it twitches, it gaps. And when you see that, you don't need a conspiracy. You need a mechanism. Mechanism number one is arbitrage. In theory, if one region pays more for silver than another, traders buy where it's cheaper, ship it, and sell where it's more expensive. That's what should keep the world in balance. So when regional premiums persist, it's telling you something is blocking that flow. Sometimes it's logistics. Sometimes it's refining capacity. Sometimes it's financing costs. Sometimes it's policy friction or fear of policy friction. And when those blockers show up, the global market stops acting like one pool and starts acting like multiple pools connected by narrow pipes. Narrow pipes mean pressure differences. Pressure differences mean opportunities. Opportunities attract capital. Capital moving fast creates volatility. And that's not the part that matters. The part that matters is what volatility forces participants to do. Mechanism number two is institutional flow. People talk about ETFs and ETPs like they're just a sentiment gauge. In silver, they can be a physical event. Big inflows can require real metal sourcing through the custody chain. Now, I'm not going to pretend every single inflow translates one for one into immediate bar demand in a simplistic way, because the plumbing is nuanced. But directionally, when a large pool of capital decides it wants exposure, it can tighten the same underlying pool that physical participants rely on. And that matters most when the market is already running hot, because that's when small marginal changes become big price changes. A little extra demand in a surplus market is a footnote. A little extra demand in a stressed market is a spark, because the marginal unit sets the price. Mechanism number three is positioning and margin. This is where 600 hours talk gets born, not because someone predicted it, but because the market starts behaving reflexively. Here's how it works in a simple chain. Price rises fast. Shorts lose money. Their margin requirements rise. Some of them are forced to cover, not because they changed their mind, but because their broker changed the rules. Covering is buying. Buying pushes price higher. Higher price triggers more margin. More margin triggers more covering. That loop can create a staircase where each step is a forced action. It's ugly, it's mechanical, it doesn't care about your opinion. And if the market's liquidity is thin at the wrong moment, those forced buys can gap through levels that would normally stop them. That's where a move starts to feel unfair. But it's just leverage meeting a tight pipe. Now add options to the mix, because options are the accelerant people underestimate. You don't need to be an options wizard to get this. When there is a lot of option activity around certain strikes, especially big round numbers, dealers who sold those options often hedge their risk by buying or selling the underlying as price moves. If price rises toward a strike with heavy open interest, hedging flows can become directional. In some regimes, the hedging can dampen moves. In others, it can amplify them. When the market is in a reflexive loop and liquidity is thin, dealer hedging can become gasoline. And the wild part is that nobody has to choose it. It's rule-based. It's risk-based. It's the system doing what it's programmed to do. The next detail is what flips the whole setup. This can coincide with the calendar because why now is never just one thing. It's the alignment. It's the compression of catalysts. It's delivery windows, policy deadlines, month-end positioning, and sometimes the weirdness of liquidity around weekends and holidays. When markets are thin, they gap more easily. When funds are rebalancing, they have to transact whether they like the price or not. When traders are rolling futures, they pay attention to spreads whether they want to or not. When a policy decision is expected, The market prices risk ahead of time, then reprices the reality afterward. If these collide in the same short window, you get forced flows on top of emotional flows, and forced flows always win, always. So let's stop arguing about whether $600 is on the horizon in a literal, immediate sense, and instead frame it properly. Targets like that are not a forecast. They're a conditional outcome. They require a sustained structural squeeze, persistent tightness in deliverable supply, persistent signs of stress in spreads and premiums, and a macro backdrop that keeps silver acting like collateral rather than just an industrial input. That's a high bar. It can happen in a disorderly world. It can happen when trust in paper claims wobbles and people demand the real thing. But it is not a promise. And you should treat anyone who sells it as a promise as entertainment, not analysis. And that's where the real edge comes from. You can be bullish without being gullible. Let's build the proof stack the way a serious metal watcher would. Layer 1, term structure. Are near-term contracts staying unusually tight relative to later months? Or does the curve relax quickly after a spike? Tight and persistent suggests genuine immediacy stress. Relaxation suggests the market is cooling. Layer 2, deliverable inventory signals. I'm not going to throw precise numbers at you like a magician because the point isn't one number. The point is direction and behavior. Are the categories that matter to delivery shrinking, stable, or being replenished smoothly? Layer 3, regional premiums and arbitrage frictions. If one region keeps paying up and the premium doesn't get arbitraged away, that's a sign the pipes are narrow. Layer 4, institutional flows. Are the big pools adding exposure into strength, or are they selling into it? The timing matters. Layer 5, the tape around key levels. Are breakouts holding, or are they failing fast and trapping late buyers? Layer 6, bonus layer, volatility and liquidity. When volatility rises and liquidity thins, the market becomes a machine that hunts stops. That doesn't invalidate a thesis. It changes the path. And that leads straight into the psychology shield because silver's favorite hobby is humiliating both bulls and bears. Even if the thesis is right, price can whip around violently. You can have a structure that points higher and still get a savage pullback that feels like betrayal. That's not the market proving you wrong. Well, that's the market testing leverage, draining weak hands and resetting positioning. If you don't plan for that, you get emotionally manipulated by the very volatility that often accompanies the move you wanted. Here are the two emotional traps silver uses. Trap 1 is the headline whip. A single sentence about tariffs, policy, or growth can make the market lurch. People overreact because it feels like new information, but often it's just noise hitting a leveraged market. Trap 2 is the gap fear. Silver loves to gap and then reverse. It makes you chase at the top and panic sell at the bottom. The antidote is simple. Separate trend signals from noise. Trend signals are structural. Spreads staying tight, inventory behavior, persistent premiums, repeated support holds, and continued demand absorption on dips. Noise is a single candle, a single headline, or a single analyst screaming certainty. So what does act before it's gone mean in a finance credible way? It means act before the setup becomes obvious to everyone, not act before you've thought. It means you build a plan for two scenarios because pretending there's only one path is how people blow up in commodities. Scenario 1 is the controlled pullback and retest. Price pulls back hard, scares everyone, then finds a support zone and holds while spreads and underlying signals stay firm. That's the market reloading. That's often where disciplined capital steps in. Scenario 2 is the continuation squeeze. Price keeps pushing, dips become shallow, and the market starts to gap on thin liquidity. That's where the risk shifts from missing out to getting chopped up. Both scenarios can happen in the same month. The question is what the signals say. Let's get concrete about the next 1 to 2 weeks, because this is where you either build trust or you lose it. I'm going to talk in zones instead of pretending I can hand you a single perfect number. If silver has been printing in the neighborhood of the high double digits, your first job is to identify the nearest breakout shelf, the area where price accelerated. If price comes back into that shelf and holds, and you see spreads stay firm and selling pressure fail to follow through, that's a confirmation of scenario 1. If price slices through that shelf like it's not there, and spreads relax and the market stops paying up for immediacy, that's a warning that the move was more fragile than it looked. But that's not the part that matters. The part that matters is the behavior after the break. Because in silver, breaks can be traps. A quick flush below a level followed by a violent reclaim is often a sign of stop hunting and positioning cleanup, not structural failure. Conversely, a slow grind lower that keeps rejecting previous support can be a sign the market is bleeding out leverage. So you watch the character. Fast flush and reclaim with stable underlying stress signals can be bullish. Slow deterioration with easing stress signals can be bearish, or at least a pause. And here's the key. You don't have to predict it. You just have to observe it faster than your emotions do. Now, where does the Trump element fit into the next couple of weeks? It fits as volatility fuel and positioning catalyst. Policy narratives can create sharp repricings, especially around deadlines, announcements, and leaks. Even if nothing new happens, the market's expectation of a headline can change behavior. Traders reduce risk ahead of events, liquidity thins, and moves get larger. That's why the calendar matters. Month-end flows matter. Delivery and roll windows matter. Any window where a large group of participants must transact creates predictable stress points. The market knows this. The market exploits this. And if you know it too, you stop being surprised. Let's also talk supply chain, because silver is not just a monetary metal. It is a working metal. It goes into electronics, solar, industrial applications, and countless components where substitution isn't trivial in the short run. Supply is not something you switch on with a button. Mining projects take years. Refining capacity is a constraint. Silver is often a byproduct of other metals, which means you can always increase silver output directly without changes in the primary metal economics. Recycling helps, but it has its own collection and processing limits. So when demand gets pulled forward, supply cannot instantly respond. That's why tightness shows up as price and premium first. And that's where the real pressure starts. Now, I want to address the skeptical viewer directly, because this audience doesn't want cheerleading. Isn't this just another metals hype cycle? Well, sometimes, yes. Sometimes silver rips, then dumps, and everyone pretends it was all a dream. That's exactly why you need the mechanism-based checklist. If the only argument is it's undervalued, or they reprinting money, you're watching a motivational speech. If the argument is the front end of the curve is tight, deliverable supply is stressed, regional premiums persist, and positioning is vulnerable, now you're watching a market structure story. Market structure stories can run longer than people expect. They can also reverse hard when the structure relaxes. Both are true. That's credibility. So what would weaken this thesis in a meaningful way? 1, a clear policy path that removes uncertainty and allows supply chains to normalize without prepositioning. 2, a macro impulse that crushes demand for hard collateral. Think a sharp strengthening in the currency environment or a sudden collapse in inflation expectations that makes people rush back into cash-like safety. 3, a demand shock in industrial channels that reduces immediate consumption. 4, visible easing in the stress signals. Spreads relax, premiums fade, and deliverable inventory stabilizes or rebuilds smoothly. Any one of these doesn't end silver forever. It changes the time frame, it changes the shape. And if you can admit that out loud, you keep your edge. Now, let's talk about the level psychology, because this is where people get played. Silver loves round numbers. Not because round numbers are magic, but because humans cluster orders there and options cluster interest there. When price approaches a big round figure, you often see the market either stall and whip or blast through violently. If it stalls, you watch whether sellers can actually push it down or whether every dip gets absorbed quickly. Absorption is bullish. If it blasts through, you watch whether it holds above on a retest. Holding is bullish. Failing is a trap. And if you're only watching the headline number, you miss the entire game. Here's a quick mental calculation that helps. In a stressed market, the marginal buyer isn't the enthusiastic retail investor. It's the forced participant. The short covering, the dealer hedging, the procurement desk that can't risk being unhedged, the fund that must rebalance. Forced participants are price insensitive in the moment. That's why parabolic moves happen. And that's why they can reverse sharply once the forced flow is exhausted. So you don't worship the candle. You track the flow. If you're wondering how people even talk about something as extreme as $600 silver, the honest answer is they're reimagining a world where paper claims get questioned and physical is demanded at scale, while supply is constrained and leverage is caught on the wrong side. In that world, price isn't about a neat valuation model. It's about clearing the market. It's about who blinks. But you don't need to believe in that extreme to trade or invest intelligently around the nearer term structure. You can acknowledge the tail risk without anchoring your entire decision-making to it. That's the difference between a serious participant and a headline tourist. So what do you watch next specifically? Over the next week, watch whether the market continues to pay up for immediacy. Watch whether any pullback is met with real buying that holds key shelves rather than just bounce and fade. Watch volatility. If it rises while price holds, that can be a sign of stress under the surface. Watch whether headlines cause one-day chaos but the market recovers quickly. That is often a sign the underlying bid is stronger than the narrative. Over the next 2 weeks, watch the calendar points. Roll behavior, month-end positioning, any policy commentary that changes perceived friction, and whether premiums and availability normalize or stay stubborn. Because if the stress stays stubborn, the path of least resistance can remain higher even when everyone feels exhausted. And let's be very clear about risk management, because silver punishes arrogance. Price can whip violently even if the thesis is correct. A trend signal can remain intact while the market tries to shake you out with noise. That's why you define invalidation. Invalidation is not, I got scared. Full Invalidation is structural. The market stops paying for immediacy, the tightness eases, and key levels fail with follow-through. If you don't define that, you become exit liquidity for someone with a plan. And that's not a moral statement, that's just how markets work. One more thing you should expect. If silver continues to act stressed, the information environment will get noisier on purpose, not necessarily by some villain, but because attention follows volatility. You'll see confident calls in both directions. You'll see people celebrating and people mocking. You all see top is an anchor to the moon on the same day. That emotional chaos is part of the game. It's how weak conviction gets harvested. Your advantage is being the person who keeps checking the same objective signals while everyone else is checking their feelings. And that's where the real pressure starts, on the people who can't tolerate uncertainty. So here's the clean takeaway. The story isn't Trump said something, therefore silver goes to $600. The story is that policy incentives and uncertainty can accelerate a shift in real-world behavior, pull forward demand, rerouting hoarding optionality, and that stress shows up first in structure, spreads deliverable supply and the inability of arbitrage to smoothly balance the world. Then, if positioning is vulnerable and options flows are aligned, the market can turn that stress into a reflexive price move that surprises everyone. In that framework, extreme targets are not prophecy. They are a tail outcome of sustained structural tightness plus forced flows. And your job isn't to worship the tail outcome. Your job is to watch the structure and ride the part that the structure supports. If you're still here, you're not the headline crowd. You're the mechanics crowd. And that's the only community that actually survives metals volatility with their sanity intact. So keep it simple this week. Watch the curve, watch the deliverable pool behavior, watch how price reacts at the key shelves, and treat every emotional headline as noise until the structure confirms it. Because if this one level breaks, the math changes.